Happy Memorial Day week. Everyone coming off a Tuesday. It's everyone coming off a Monday hangover. I had a brain fart there. All right, guys. This is where rates are sitting. Not quite a bit of movement last week, not in our favor. We'll take a look. And today's not looking good either. We're down 7 basis points. This is a real tough one here because we're battling with this support line here. And if we break below, which we did today, then we got another support right here. And, the reality is we're trying to get back up here. We had a nice rally, but look, we've had a pretty consistent week and a half of just rates deteriorating. So, where our rates sitting, according to Mortgage News Daily, this takes an average, right, of all the different lenders. You're looking at a 30-year fixed conventional sitting at about 7.14. I think that's a little aggressive, honestly. But yeah, 714, 725, 7375 on conventional. That's about where everybody's sitting, depending on their margin. 15-year fixed, 30-year fixed FHA 6.75. That's about right. VA 6.75. Jumbo sitting about 7.375, 7.5. Yeah, all that seems accurate. I saw an ARM loan come in this week. I mean, last week. That was kind of wild. Big push that we made was HELOCs. We did probably about 700,000 in HELOCs last week. Opened a few new escrows this week. The market is the market. So the market is going to change over time. And what's really been a factor that we want to look at is, and you'll want to pay attention to this because this is an important sales point for everyone who's out there shopping or thinking about buying a home. The year-over-year appreciation was just reported by FHFA. It was almost 7% appreciation. And so you look at that and you think, man, rates are atrocious, and they've been atrocious for the last 2 years, yet home prices still went up. And that's just supply and demand. So there's not enough supply to meet the demand, and there's not enough people moving. And imagine when rates hit 3-4%, like it's just going to explode. I mean, absolutely explode. And I personally have been trying to manage my expectations and manage my personal portfolio and figure out what's the best way to proceed. What's the best way to go forward, knowing that we've experienced this inflation, knowing that the feds are eventually going to cut rates, knowing that over the last 4 years, 4 of the 10 American dollars have been printed. So and I'm breaking my head on all this, and I think I got some good ideas. I think that right now we're sitting at a new baseline. I think that with the prices we're experiencing, that's just what they are. Prices aren't going to come down. Inflation is going to continue. They're going to slow it, so it's not going to be as rapid. But the fact is, there was so much more money put into the economy and so much more credit that was available that people have been living off of the credit, and the markets got all blown up because of all the money that came in. And so I was trying to figure out, where did this money go? Well, the stock market is in all-time highs. Bitcoin is a new variable that wasn't around even 5 years ago, right? 6 years ago, really in like 2017, 2018, that's when they had its first run. But not like it is now at 68,000. So where did the money go, right? So the money went into Bitcoin. The money went into the stock market. The money went into housing. The money went into, different developments. It's no longer with the common folk. That's it. The stock workers got their money. The wealthy people got their money. Typically, you want to see a regression to the mean, meaning at some point they pull a rug out from underneath, there's a dip, and then everything blows back up. But I don't believe that we're going to see any dips. And the reason why we're not going to see any dips is because of what I just said. So much money just got put out into the economy. So much money just got placed into people's pockets. It got put out. And so now people are living off of all this extra stimulus that came over the last 4 years. And so as I'm really trying to manage the thoughts of what to do next in my portfolio, it was like, well, what do I know the best? I know housing. So I'm in escrow on another investment property. And it's like, well, do I want to play the stock market? What's going to happen with rates? Well, if rates get cut, the housing market's going to explode and everyone's going to be in the housing market. Well, what happens if rates get cut? Well, that also is going to cause the stock market to hit all-time highs because money becomes cheaper. So if you're going to take anything from this video, here's what you take from it. Housing appreciated almost 7% year over year, while rates were 7%. The appreciation rate that we're going to experience between rates going down to 4 and the next bull run, which will probably be another 10 years, it's going to be insane. You're looking at probably another 30 to 40% increase in prices. Now, where it starts to get interesting is when they start to make money more available. If FHFA just announced and they said, hey, house prices appreciated 7%, they're likely now come October, November, going to increase loan limits. And so just like student loans, when student loans became available, the cost of universities skyrocketed. And so what's going to happen? Well, they're going to increase the loan limits, just like they did last year. And so now all the house prices are going to go up and rates are going to go lower. And here's a factor that no one's talking about. It's a 30-year fixed amortization. If they don't want to lower rates, but they want to lower payments and make money more affordable, the solution is extending the payment to 40 years. People are living longer. And that's next. And I can see that coming. Once they privatize, especially if there's a change in regime, they're going to privatize the secondary market. And it's no longer going to have government control. They'll start coming up with these wild products. And I bet the very first thing that they're going to announce is we're going to announce a 40-year product. And that's just going to cause everything to go up. So this is the new norm, right? Put your money in housing, put your money in gold, put your money in assets. I'm not a financial advisor, so, I'm just I'm wearing a t-shirt, so don't trust me. But that's what I'm doing. Putting all my money in assets, buying some stocks and going right back into the S&P 500 today. And I'm buying the S&P 500 because that outperforms most hedge funds. You don't need to go pay a broker. Put your money into the S&P. Drop 30, 40K if that's what you got. Drop 30, 40K. I can put in a stop loss at, somewhere. But the prediction is S&P's at 5,300. It's going to go to 5,600 within the next week. The 10-year bond is moving up, right? It is what it is. So keep strong. Stay out there. Again, if anybody's on the fence, now's the time. And every day forward, now's the time. That's the message. Now is the time. Hope you guys got some value. If you did, my Instagram, Mortgage Coach Tony, shoot me a DM. And all my realtors that are going to actually watch this, hopefully you watch to the end. Thank you so much for your support, your business. Much love. Peace out.